Picture the most powerful country on Earth. It has the world's largest military, the world's reserve currency, the most liquid financial markets in human history, and it cannot pay its bills without borrowing more money every single year. Not because of a bad recession, not because of a war, not because of some temporary crisis that will eventually pass. Just structurally by design and as a matter of policy. In 2024, the United States government spent roughly $6.75 trillion. It collected about $4.9 trillion in taxes. That's a gap of nearly $2 trillion. In a single year, in a relatively normal year, with no major war, no financial collapse, no pandemic, $2 trillion of new debt added to a pile that already stood at $34 trillion. And here's the part that should stop you cold. Nobody in Washington is seriously trying to fix it. Why this matters right now? You might be thinking I've heard this before. The US has always had debt. It's always been fine. And you'd be right. Historically, that's true. But something shifted around 2020, and the math since then has entered territory that professional economists quietly describe as uncomfortable. For most of the last decade, the US could borrow money at near zero interest rates. Debt was almost free. You could run deficits and barely feel the cost. Then inflation hit. The Fed raised rates fast. And now the US government is paying interest on its debt at rates it hasn't seen in 15 years. In fiscal year 2024, the US paid over $1 trillion in interest alone. Not principal, not programs, not defense. Just the interest bill on existing debt. $1 trillion in interest. That number just crossed the total US defense budget for the first time in history. Let that breathe for a second. The country that spends more on its military than the next 10 nations combined is now spending more on its credit card bill than on its army. That's not normal, that's the inflection point. And that's why this conversation is happening right now. To understand where America is, you need to understand how sovereign debt actually works. When a government spends more than it collects in taxes, it issues bonds, Treasury bonds. It borrows from the public, from pension funds, from foreign governments, from the Federal Reserve. In exchange, it promises to pay interest and eventually return the principal. This system works as long as three things remain true. 1. People trust you'll pay them back. 2. The interest rate you pay is manageable. 3. Your economy grows fast enough to make the debt feel smaller over time. For most of the post-war period, the US had all three in abundance. The dollar was the world's reserve currency. US treasuries were considered the safest asset on Earth. And the American economy consistently grew. So even as the debt grew in absolute terms, it stayed manageable as a share of the economy. The GDP ratio stayed in a zone most economists considered sustainable. Then came 2008, the financial crisis. A massive stimulus response, quantitative easing, the Fed buying government debt on a scale never seen before. Then came 2020, COVID, another massive stimulus. Multiple rounds, trillions of dollars injected into the economy in the span of months. The debt jumped from around 23 trillion at the start of 2020 to 28 trillion by the end of 2021. But interest rates were still near zero, so the cost of carrying that debt felt almost weightless. Policymakers made a quiet bet that rates would stay low, that they could keep borrowing cheaply indefinitely. That bet is now losing. Here's where we get into the numbers people prefer not to look at too closely. The US debt to GDP ratio is currently around 122%. That means the total debt is larger than the entire annual output of the American economy. For context, the IMF generally considers anything above 100% to be a zone that requires careful management. Above 120%, you start entering territory associated with debt crises in other countries. Now, the US is not Greece. It's not Argentina. It controls its own currency. It has enormous institutional depth. The dollar's global reserve status gives it what economists politely call exorbitant privilege. The ability to borrow in its own currency, essentially without limit, in a way no other country can. But here's the uncomfortable part. That privilege is not unconditional. It's not written in stone. It rests on a foundation of confidence. And confidence, once it starts to crack, can shift faster than markets expect. And there are signs, subtle but visible, that the foundation is under pressure. Foreign ownership of US Treasuries has been declining. China, once one of the largest holders, has been selling. Japan, the largest foreign holder, has been under pressure to sell as well, to defend its own currency. Central banks globally have been diversifying away from dollar-denominated assets, slowly, quietly. None of this is a panic. None of this is a crisis yet. But the direction is notable. And here's the math that makes it worse. As rates stay elevated and debt keeps growing, the interest burden compounds. Higher debt means more bonds issued. More bonds means higher supply. Higher supply, if demand softens, means higher yields. Higher yields means higher interest costs, which means bigger deficits, which means more debt. It's a feedback loop, and the US is already inside it. The Congressional Budget Office projects that by 2034, the US debt will reach $54 trillion. Interest payments alone could consume 20% of all federal revenue within a decade. 20 cents of every tax dollar, just to service debt that already exists. Now, every few years, Washington performs a ritual. Politicians from both parties stand in front of cameras and talk about fiscal responsibility. They debate debt ceilings. They threaten shutdowns. They form bipartisan commissions. And then they increase the debt ceiling anyway. Every single time. The debt ceiling debate is one of the great pieces of political theater in the modern world. It's a limit that Congress sets on itself, and then overrides when it gets inconvenient. It has been raised or suspended over 100 times since it was introduced. It's like setting a personal spending limit, and then raising the limit every time you approach it, and then calling a press conference to announce how fiscally serious you are. On taxes, both parties broadly agree that taxes should not significantly increase, at least not on voters who show up reliably to elections. On spending, both parties have core constituencies that depend on the programs they protect. Defense, Social Security, Medicare, Medicaid. These 4 items alone account for the bulk of mandatory spending. And here's the quiet truth. Even if you eliminated every discretionary program, every dollar of education spending, infrastructure, foreign aid, scientific research, federal agencies, you would still have a deficit. The structural deficit is baked into the mandatory spending commitments already on the books, driven primarily by an aging population that is drawing on Social Security and Medicare faster than the working age population can fund it. This is not a political argument, it's a demographic one. The baby boomers are retiring. There are more of them drawing benefits than there are younger workers funding the system. And that ratio is only going one direction. No party created this alone. No single policy caused it. It's the result of decades of promises made to voters who are now collecting on them. The bigger picture, what actually happens. So what does a sovereign debt crisis actually look like for the United States? This is where people tend to imagine 2 scenarios. Either nothing bad happens because America is America, or there's some catastrophic collapse. Dollar crashes overnight, Mad Max energy. Neither is quite right. The more likely scenario, the one serious economists actually discuss, is slower and more insidious. It's called fiscal dominance. Fiscal dominance is when a government's debt situation becomes so large that it starts to constrain monetary policy. When the central bank can no longer raise rates without causing a debt spiral. When the Fed essentially has to keep financial conditions loose, even when inflation would normally demand tightening. Because the alternative is making the government's interest bill unbearable. In other words, inflation becomes the silent mechanism through which the debt is managed. Not default, not a crisis. Just a slow erosion of purchasing power. Savings lose value. Real wages stagnate. The middle class quietly absorbs the cost of a debt they never voted for and largely don't understand. This has happened before, not dramatically. Not with a single visible breaking point. Just a decade of quiet decline. And there is an external dimension to consider. The dollar's reserve status is not just a financial privilege, it's a geopolitical one. It allows the US to impose sanctions, to to exclude countries from the global financial system, to project power through financial tools in ways no other country can replicate. If confidence in dollar-denominated debt erodes, if the shift away from treasuries continues and accelerates, that power erodes too. Not in a day, not in a year, over time. And the countries that would benefit from that shift, they're already working on the alternative plumbing. BRICS payment systems, bilateral trade in local currencies, central bank digital currencies designed to bypass the dollar entirely. None of it replaces the dollar tomorrow, but the architecture for what comes after is being built right now. The question nobody wants to answer. Here is where we arrive at the part of the story that stays unresolved. Because there are really only three ways out of a debt problem this large. You can grow your way out. GDP growth strong enough to outpace the debt accumulation. The ratio comes down. The burden becomes manageable. This is the optimistic scenario. It requires sustained productivity growth, possibly driven by AI, possibly by an energy revolution. Possible, not guaranteed. You can inflate your way out. Let inflation run higher than normal for an extended period. The real value of the debt decreases. Creditors get paid back in money worth less than what they lent. This is the historically common solution. It is also a form of default in slow motion. Or you can actually cut. Meaningful structural cuts to mandatory programs. Higher taxes on a scale not seen in decades. Political pain distributed broadly and immediately. This is theoretically possible. It has never happened in American political history at the scale currently required. Most serious analysts believe the answer will be some combination of the first two, with a nearly complete absence of the third. Which means the bet, ultimately, is on American productivity, on the dollar maintaining enough credibility to keep the cycle going, on no major shock, no war, no financial contagion, no sudden loss of confidence, arriving before the growth does. It's not a crazy bet. The US has beaten long odds before, but it is a bet, and the stakes have never been quite this high. In 2024, the United States government borrowed approximately $5 billion per day. Every day, weekends included, not to invest in the future, not to build infrastructure or fund research, mostly just to service the debt that already existed, and to keep the government running. The system continues to function, markets continue to lend, the dollar continues to hold, and somewhere in a Treasury office in Washington, someone is quietly issuing more bonds tomorrow. The question isn't whether this is sustainable. The question is, how long can something unsustainable keep going? And more importantly, who pays the bill when it stops?